The only uh, thing that would make sense about a revaluation of gold is if we're going to uh, maybe go back on a gold standard, have an official devaluation of the dollar, including of our debt. Because if we were to say, okay, gold is now $20,000 an ounce, and we're going to repay our debts in gold at $20,000 an ounce, right? So now, we've basically defaulted on a lot of our debt without really defaulting, because we're going to pay it off in gold. And we just said that the gold is now worth 20,000 or 30,000 an ounce.
Recent developments in global financial markets have highlighted a steady yet deliberate shift in how central banks manage their reserves, with many increasing their gold holdings. This trend reflects a cautious move away from an over-reliance on the US dollar, driven by persistent trade deficits and concerns about long-term currency debasement. Countries with large dollar surpluses, particularly in emerging markets, are diversifying their reserves by accumulating gold, a physical asset with intrinsic value and a long history as a store of wealth. Despite gold offering no yield and requiring storage costs, its appeal lies in its stability and universal acceptance, which digital currencies like Bitcoin have yet to replicate in official circles fully. Prominent investors, such as Peter Schiff, have long warned about the risks of fiat currency inflation and continue to advocate for gold as a reliable hedge against economic uncertainty. The idea of officially revaluing gold often surfaces in economic debates, but without structural changes to the monetary system, such revaluation remains largely symbolic. Simply increasing the nominal price of gold on paper does not create new wealth or improve purchasing power unless the dollar is explicitly pegged back to gold through a formal gold standard. Historically, the US dollar was directly convertible into gold, which gave it real value. This link was abandoned because the gold standard imposed strict limits on government spending and debt expansion, limits that modern policymakers are unwilling to accept. Peter Schiff emphasizes that returning to a gold standard would force governments to address fiscal imbalances and rein in deficit spending. Meanwhile, the growing enthusiasm for Bitcoin as a potential digital gold has yet to translate into widespread adoption by central banks. While Bitcoin has gained substantial popularity among retail and institutional investors, especially in the United States, it has not yet become a mainstream reserve asset for sovereign wealth funds or central banks. Central banks continue to prefer gold due to its tangible nature, centuries of proven stability, and universal trust across economic systems. This cautious approach underscores the preference for real, physical assets when it comes to official monetary reserves, while cryptocurrencies remain highly volatile and speculative. Now, we present the clips from Peter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think there'll be demolition. I don't think it's controlled in any way. Look, I mean, revaluing gold, our official value, I mean, doesn't change anything. I mean, if you just say, okay, we're going to count our gold, instead of saying it's worth $42 an ounce, we're going to say it's worth $3,300 an ounce. That's just an accounting. It means nothing, because, we're not doing anything with the gold. And if the U.S. government was going to sell the gold, it wouldn't sell it at $42. It would sell it for the market price. So it doesn't change anything. There are people who think, well, this gives us extra money to spend. No, it doesn't. It doesn't give us anything. Senator Loomis says, well, let's revalue the gold and then use the money to buy Bitcoin. What money? There is no money. There's just the gold. You don't get any extra money. But if what she's saying is, well, let's use the gold and somehow print more money. Let's have the Fed print up a bunch of money because we've now officially recognized what the gold is worth. And then we're going to take that new money that we just printed and use it to buy Bitcoin. It's like, okay, let's create inflation and buy Bitcoin, right? Why would we do that, right? Why would we just debase the currency just to go out and buy Bitcoin? So it doesn't solve any problem. The only thing that would make sense about a revaluation of gold is if we're going to maybe go back on a gold standard, have an official devaluation of the dollar, including of our debt. Because if we were to say, okay, gold is now $20,000 an ounce, and we're going to repay our debts in gold at $20,000 an ounce, right? So now, we've basically defaulted on a lot of our debt without really defaulting, because we're going to pay it off in gold. And we just said that the gold is now worth 20,000 or 30,000 an ounce. So we wipe out 90% of our debt. But it doesn't even make sense to do that unless you're going to peg the dollar to gold and maintain that. But at this point, and initially, of course, the dollar wasn't pegged to gold. The dollar was gold. I mean, that was the literal definition of a dollar. A dollar was a weight of gold. That's what it was. It was a way to measure gold. If you had a certain quantity of gold, it was called a dollar. That was the legal definition. Gold was our money. Our money wasn't backed by gold. Our money was gold. What we eventually did is we created currency that was backed by money. But the currency was never money. It was a money substitute that you could use instead of money because it was more convenient than money. But what gave currency value was the money that backed it up, which was gold. So if we were to go back on that standard, yeah, that'd be great. And we can't do it unless we devalue the dollar officially and reprice gold. But I don't see any appetite in Congress to do that, because that would mean they'd have to cut spending. And so, but they're not cutting spending now. So why do they want to go back on a gold standard that would force them to cut spending? The reason we went off the gold standard is because politicians wanted to spend a lot of money that they didn't have. Gold was preventing them from doing that. And, when I hear people in the crypto community say, oh, gold didn't work, gold failed. Gold worked perfectly. That's why the U.S. government abandoned it, because it was doing its job. It would have stopped them from deficit spending. It would have forced politicians to make difficult political choices that they didn't want to make. So instead of making those choices, they chose to leave the gold standard, right? But that doesn't mean that gold failed. That's people, human beings failed, right? And Bitcoin doesn't fix that. Donald Trump has made it clear that we can't have these trade deficits. And okay, that means we're leaving the dollar's reserve status. Because it's a consequence. Our trade deficits are a consequence of the dollar being the reserve currency. And that's what enables us to live beyond our means. And this is in the process of ending. And that's why gold moved from about $2,000 an ounce at the beginning of last year and to now, 3,300, right? It's got as high almost 3,500. So if we've had a 50% move in the price of gold. During that time, you didn't see a lot of public interest. I mean, most Americans were selling gold for that entire run. It's been central banks that have been accumulating. And why are they accumulating gold? Because they are divesting of dollars, right? They are converting their dollars into gold, and they're shunning the interest that they could earn, because when you have dollars, you could buy treasuries and earn 4%. When you have gold, you earn nothing. In fact, you got to pay a little bit of money to store it, or maybe you've got your own storage facility, but you got to pay for the facility. It doesn't cost anything to store treasuries, and you get paid a yield. But the fact that these foreign central banks don't want that yield shows you that they realize the yield is not enough to make up for the loss of value of the dollar. And so they'd rather own gold that yields nothing than dollars that yield something. And so far, the return that they've had on their gold dwarfs the little bit of interest they would have earned on their dollars. And I think for that reason, gold's going to keep on rising. If you look at the amount of gold that most central banks own, particularly in the emerging markets and the countries that have the largest surpluses with the U.S., they have the most foreign exchange reserves. They still have a tiny fraction of those reserves allocated to gold. And they keep growing because they keep accumulating more dollars, because they keep having these surpluses with us. So more and more of that money, of those currencies, are going to move into gold. So gold is replacing the dollar as the primary monetary reserve. It's not the euro that's replacing the dollar or the pound or the yen or the RMB or any of these currencies. It's real money. I mean, because before the dollar was the primary reserve, it was gold. And the only reason that the dollar was accepted as the reserve was because it was redeemable in gold. So if you had Federal Reserve notes in the 1950s and 1960s, you had gold. When they said the dollar was as good as gold, they meant it, because the dollar was gold, except you could earn interest. Now, we screwed the world over when we defaulted on that promise, but it was initially gold that was the reason the world accepted the deal at Bretton Woods. So I think that is in the process of changing. But what's interesting from your perspective, and you should think about this, is if you're so sure that Bitcoin is the new gold, is superior to gold, is better than gold, why are these central banks not buying it now? Why are they all buying gold? If gold is the past and Bitcoin is the future, why are all these central banks ignoring Bitcoin and just buying gold?
Because they're full of PhDs that don't understand economics, obviously.
Yeah, I think the foreign central bankers
They'll come
know a
around.
lot more about economics than the millennials in the United States. I looked at a statistic. I think 40% of all the Bitcoin is owned by Americans, and about half of all the people in the world who own Bitcoin are Americans. So this is becoming an increasingly U.S. thing, as Americans are some of the only people dumb enough to buy it. Like we're loading up on all this crap as the rest of the world is getting rid of theirs. They're selling us their Bitcoin, and they're buying real things. They're making real investments. They're building factories. They're making consumer goods that improve people's lives. What do? We manufacture meme coins. What the hell does that do? And then we trade them.
Recently, signs of stress in the bond market have become increasingly clear, and experts like Peter Schiff warn that the U.S. is facing a precarious financial situation. Despite an enormous national debt, interest rates remain unusually low, something that defies typical economic logic. Typically, a borrower burdened with heavy debt pays higher interest rates because lenders perceive a greater risk. Yet, the U.S. continues to borrow at low interest rates, which many believe is unsustainable. If the Federal Reserve decides to cut interest rates again to support the economy, the opposite effect may occur. Long-term rates could climb as investors grow anxious about rising inflation and the declining value of the dollar. Foreign investors, who hold a significant portion of America's debt, are particularly sensitive to currency fluctuations and may begin selling off U.S. treasuries, stocks, and dollars to protect their wealth, which could further weaken the dollar and push bond yields higher. Peter sees that if the economy weakens further with rising unemployment, but inflation remains stubbornly high, the Fed might have no choice but to return to quantitative easing, QE, to stabilize the bond market by buying up debt that no one else wants. However, this creates a dangerous feedback loop. Printing more money to buy bonds can increase inflation, which in turn makes bonds less appealing, prompting even more selling and forcing the Fed to intervene again. This cycle threatens to unravel the economic structure that has depended heavily on artificially low interest rates and affordable imports. With tariffs pushing import costs up and the dollar losing strength, prices are surging, and the U.S. economy's shaky foundation risks collapse. The worst-case scenario could be uncontrollable inflation or hyperinflation, which would have devastating consequences for the country's financial stability.
QE is going to come when the bond market, I guess to use Trump's words, really gets yippy. But
But
maybe
we're already higher than when he first said it was getting yippy.
Yeah, I mean it's about the same. It's not. It's because we had gotten to about 4.5 on the 10-year and about 5 on the 30-year, and so that's about where we are. But those are still low rates. They're not as low as they were, but if you go back, since the end of this Second World War, those are still low rates that we've got. And considering how much
amount
debt
of debt we have, though,
we should have higher rates. When the more debt you have, if somebody goes to borrow money and they don't have a lot of debt, and you go to a bank or a lender, and you've got a pretty good personal balance sheet, and you want to borrow money, you'll get a certain rate. But if somebody else comes and they're loaded up with debt and they want to borrow money, they're going to pay a higher rate because they're a greater risk. They have a lot of debt, so that means that they may not be able to pay it back. So you don't want to loan money to somebody who's already broke. You want to loan some money to somebody who can pay you back, easily. And so we're broke right now. We have trillions and trillions of debt, yet we still have interest rates as if we were, solvent, which we're not. But I think that the position we're in now is that if the Fed cuts rates again, long rates are going to rise again, just like they did before. The Fed cut rates to about 100 basis points, but then long-term rates rose 100 basis points. So the long-term rates did the opposite of what the Fed wanted. And I think that if the Fed goes back to rate cuts, the long end is going to go up. And that's going to be because the bond market is going to be worried about the inflationary impact of the and the impact that it's going to have on the dollar, because a lot of the holders of our debt are foreign. And so when they look at our debt, they don't look at it from the prism of a dollar. They look at it from their own currency. And so if you're European and you've got money in US treasuries and you're getting 4 or 5%, but you're a euro-based investor and you think, well, the dollar could drop another 10 or 20% this year in terms of euros, why would you want to just hold those treasuries? You're just going to lose a lot of euros holding treasuries. And so I think you're going to see more selling in the bond market as the dollar goes down. In fact, what you're seeing now is foreigners are selling all their U.S. assets. They're selling their U.S. stocks, their U.S. bonds, their U.S. dollars. U.S. stock market's been overvalued for a long, long time now. And now finally people are starting to notice how expensive our stocks are. And now that the dollar is falling, it makes it even riskier for foreigners to own those stocks, but particularly the bonds. Because at least with a stock, you can say, well, the stock could grow and their earnings can grow. And so even if the dollar is going to drop 5 or 10%, I can still make more if the stock grows by 20 or 30%. But when you're buying a bond where the most you can get is the coupon and the coupon's 4 or 5%, there's no way to offset the foreign exchange loss. So when the bonds really start to get hit and interest rates rise, and if we start to see especially a big upturn in unemployment, right? So now the economy is weakening and interest rates are rising. Even if inflation is rising, the Fed is going to go back to QE because it's going to be the only way that it can try to, lower those rates, because rate cuts won't work. They're going to have to go into the market and buy the bonds that nobody wants. But the problem is, in order for the Fed to buy the bonds that nobody wants, it has to create the dollars that nobody wants to pay for them. And so the more money the Fed prints to buy bonds, the worse off bonds become as an investment, because now they're creating more inflation to buy bonds that people don't want because there's too much inflation. But now there's even more. So it becomes a self-perpetuating spiral. The more bonds the Fed buys, the more bonds the rest of the world wants to sell. And, if the Fed is just buying treasuries, well, what happens to the mortgage-backed securities? Well, they get, so now they got to buy those. But what about corporate bonds? Are they going to start buying those? Municipal bonds? Because, interest rates are just going to spike. And our economy is based on two things. It's based on artificially low interest rates and cheap imports. And if prices are soaring because we can't import stuff cheap anymore, either because of tariffs or a weak dollar or a combination of both, and interest rates are soaring because we have so much debt and the rest of the world isn't willing to finance it, then our whole economy that was built on that foundation collapses. And then the risk is that the inflation runs out of control. And then you get into a hyperinflation scenario, which, is the worst of all possible outcomes.
Looking ahead, as concerns over currency stability and rising debt levels intensify, there is likely to be a more pronounced global shift toward assets with intrinsic value as a foundation for preserving wealth. This evolution will extend beyond simple reserve diversification, prompting a reassessment of monetary frameworks and financial security in an environment where traditional fiat currencies face growing pressures. While discussions around adjusting the official valuation of such assets may become more frequent, meaningful progress will depend on comprehensive monetary reforms that restore a tangible link between currency and real value alongside stricter fiscal discipline. Without these fundamental changes, attempts at revaluation may remain largely symbolic, leaving inflation unchecked and driving investors and nations alike to seek more dependable stores of value, ultimately influencing the future architecture of global finance. That's it for today. Share your thoughts on Peter's analysis of gold revaluation in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.